Hello, everyone. Matt Clark, research analyst for Money and Markets here with your Bull and the Bear podcast, kind of our weekender edition, if you will. And it's good to be back. Last week, we kind of took a bit of a hiatus as myself and Charles Sizemore, we kind of took time to spend with our families. I was in Atlanta, he was in Dallas, and just the recording thing it didn't make a whole lot of sense. So, but we're glad to be back, and we're ready to kind of cruise out of 2020 into 2021. And give you safe and sound, profitable investment information for your portfolio. I want to jump right in today, and we talked about this time and time again. It's been a rotating conversation since March, and that is the fact that how we work has evolved into something that is likely going to stick around even beyond the coronavirus pandemic. The coronavirus has I don't want to say forced, but has prompted thousands of companies and millions of Americans to change how we work. And as I said, those changes could be long lasting. We've been forced to work from home. Charles works from home in Dallas. I work from home in South Florida. I have an office that's literally 5 miles away, but we're, in order to be safe and in order to protect ourselves, the Money and Markets team, we all work remotely. And like I said, that's something that's likely not going to go away. If you look at companies like Facebook and Google, they're keeping their employees home working remotely at least until the summer of next year. So, and I think this is going to be kind of a common thread. But because of that, we've seen some sectors in the market really not necessarily take advantage, because they really didn't do anything, but they have benefited from this change in our work environment. And it's mainly tech companies, because, when you work from home, your setup at work or things like that isn't necessarily the same as what it is at home. So when you work from home, it has to kind of mirror that. You need the same kind of security. You need the same kind of data storage. You need the same kind of access. You need all these types of things that allow you to keep producing as you were in the office, if not even increase that productivity. And since its inception in June of 2020, the Direxion Work From Home ETF, which trades on the New York Stock Exchange under WFH, clever, it is an exchange-traded fund that invests in companies capitalizing in this new change of how we work, has grown about 21%. Now, that doesn't seem all that much, but you have to consider this ETF was not around during the March drop, during the coronavirus crash. So it's coming in kind of, late, as it was just started kind of in the middle, late June. So what I want to do today is bring in, and I'm not going to call you a contributor anymore. I'm just going to call you, Charles Sizemore, because I think we're past the contributor. You've done way more than that. You're a much bigger part of the team than that. So Money Markets, Charles Sizemore is going to join me here, as you can see here, or you'll hear here shortly. And we're going to talk about two work from home companies, or companies that are actually in the work from home ETF that I just talked about. And we're going to give you our take on whether these are potential buys or not. And first I want to welcome Charles and thank you for coming in. I hope you had a great holiday week last week. This work from home trend is I think it's going to stick around even beyond 2021.
I think it will too. I think at some point, maybe 5 years from now, companies will look back and they'll realize that, well, maybe working from home wasn't the end all be all. There are some productivity issues. Not everyone is motivated enough to stay on task. Some people end up sitting on the couch watching TV half the day.
I wish.
You also miss out on some of the collaborative. It's easier to collaborate remotely than it used to be, of course. But you still miss that ability to just knock on someone's door and spitball ideas. It's not quite the same.
That face-to-face is gone. I mean, that personal touch is kind of gone.
Well, and I had this conversation with one of our colleagues. Actually, you were there as well. And that was, there is a certain value to just being around and, having drinks after work. And that's where sometimes really good ideas come to fruition, right? They don't always happen in a formal meeting setting. Sometimes they just happen on the fly from personal interactions. So I have a feeling that working from home it's still going to be on an upward trajectory, or at least it's going to be steady where it is now. Probably at some point in the next 5 years, companies kind of rethink it and maybe try to create something else, some sort of balance where we're in the office more. But I think for the next several years, the trend is going to be to work from home. If you're able to work from home, you work from home.
I agree. And I think by the time we may be settled and maybe ready to return to an office setting en masse, there's going to be something technology-wise that's going to come out that's going to make it almost preventative to do so, just because the technology is going to be so good. There's going to be that question of, okay, well, why would we do it?
Why would we pay the rent?
Exactly. And that's, I think, another thing here that kind of goes unsaid here is that, the amount of money that companies, especially companies that have a sizable office presence, whether it's Class A office, Class B office, whatever, the amount of money they save on triple N rent or just on rent in general by having their employees work from home could be enough to really tip the balance in terms of just maintain, because productivity, on all honesty, a lot of studies out there actually show that people are more productive at home than they are in the office because
I don't believe that.
Well, yeah, I think it really kind of depends on your work ethic. I mean, I agree. I'm sure there's probably some that are sitting at home right now that are supposed to be doing something and they're watching Days of Our Lives or something like that. I don't know, or Sports Center or whatever.
I have young children in the house, so I'm biased. It is what it is.
Exactly. And there's that too. I mean, there's the other thing is that some people prefer that office setting because there's less distraction, whereas some prefer the home setting because there's less distraction. So it's just kind of a preference. But anyway, to jump in, the first company I want to talk about, it's a company that you've heard of. They don't necessarily have their name stamped on a ton of products, but they are an open platform for app development, workflow solutions. They have a cloud business communication services division. They actually work in partnership with RingCentral, which is what we use to do these meetings and these podcasts like we're doing now. Its trailing 12-month sales were about $2.8 billion. It's got a one-year annual sales growth rate, however, of a negative 0.48%. The company's annual sales have been relatively steady at around $2.8 billion for each of the last 3 years. So their sales have been flat. They really haven't gone up. But on the flip side, they haven't really gone down. And their most recent earnings per share for the company is a negative $7.25 per share. Since hitting a low of around $6 a share back in March, which is everyone's common benchmark for hitting lows because that was the coronavirus crash. I say it every time, but it almost seems it's repetitive and most people know it. The company's stock has actually bounced about 188% to its current price point. And its gains are pretty much right in line with the rest of the software industry. The company here is Avaya Holdings Corporation. It trades on the New York Stock Exchange. The ticker is AVYA. It's Avaya Holdings. Charles, I'll first throw it to you and give me your thoughts on Avaya.
Yeah, so the sort of lack of profitability I find a little bit disturbing. I kind of sounded like Darth Vader there. I find your lack of faith disturbing. What was he said? Anyway.
That was it. You got it. It's either Star Trek or Star Wars with you, man. I can't really tell from one week to the next. I appreciate it coming
franchise, Stargate, which that one's clearly.
Let's stay away from that. We're not going to do that.
That one's a tear down.
Yeah.
Anyway, this stock, it has a lot of momentum behind it, and despite that, it's not a high volatility stock, and I like that. Tech stocks have not done, exceedingly well over the last couple weeks. There's been something of a rotation out of tech and into beaten down value stocks. This stock seems to have bucked that trend to a certain extent. It's just continued to push higher. I like that. Longer term, I do find the lack of sales growth disturbing. I do find it not disturbing, but I do.
It's concerning.
It's concerning that, come on, if you're not boosting your sales this year, then when are you? For me, this is more of a short-term momentum play. I think this is a buy for the next, call it 3 to 6 months. I don't know that I would want to hold it. Well, maybe I would want to hold it longer than that. We'll see. But my targeted time frame, at least entering the trade, would be 3 to 6 months. Maybe reevaluate what it looks like then. But I would buy this one. I would call this one a buy, but again, with a relatively short window.
Yeah, I looked at Chief Investment Strategist Adam O'Dell's 6-factor green zone rating system. Avaya actually ranks around a 56 as of today, which means it's fairly neutral. We don't necessarily expect it to under or outperform the market over the next 12 months. It does have very good momentum. And if you do remember, kind of our philosophy here is buy high, sell higher. So we do look at momentum pretty heavily. It ranks around a 79 on momentum, which is good. It's not great, but it's good. It also does rank very high, ranks a 72 on volatility, which means it's a fairly low volatile stock. However, it is a big company. It's got a $1.5 billion market cap, so it does rank a little low in size. It does rank low in quality, right around, I want to say a 39. It's a low growth stock. It's kind of a low value stock. It's kind of, I mean, its price to sales is actually lower than the rest of the industry, which is good. Its price to book is also lower. So in terms of comparing it to the rest of the industry, it is a decent value. Its return ons are all in the negative, but then again, software is all in the negative across the board. I agree with you here. This is not a long-term buy and hold. This is not one of those that you want to hold in your portfolio for 12 months. I just don't see the potential for long-term gains here. I think 3 months is probably the most I would hold this. I don't even know that I would go 6 months out. Because again, as you said, if they haven't been able to produce an increase in sales, and they will have an increase in sales this year, it's just not going to be much. Like I said, they've been holding at that $2.8 billion level for 3 years, and I think it's going to be around $2.9 billion. Maybe they may crack the $3 billion mark this year. That's nominal compared to what other tech companies are able to do, considering how things have changed in terms of our work environment and how we're doing things. So for them
the other thing to consider is, okay, it's a high momentum stock, well, moderately high momentum stock today, but at some point the fundamentals have to catch up with that price momentum.
Exactly.
Or what
exactly.
Doing, right?
And that's why this is a very short-term play. 3 months tops, and then you're probably out of it. In fact, I don't even know that it goes 3 months. I think the momentum is probably going to kind of peter out by January, maybe February. And I think it's going to start to either level out or dip or start to drop back. So again, I agree. I think it's a buy, but it's certainly not a long-term one. It's one you definitely want to do your research on, and we've kind of helped you with that. We've kind of pushed you in that direction. The return ons kind of worry me. Return ons are deeply in the red. Return on equity is around negative 89%. That is a bit concerning for me. Their debt is about $3.7 billion right now, and with its trailing 12-month sales of 2.8 billion, that's a concern. So there are some red flags here, but if you're wanting to take advantage of maybe some short-term momentum swings, then this is one you might want to get into and look at for about 3 months, and then that's it. But again, you want to watch it. So I would say buy, but I'm very hesitant about it. So that's kind of where I look at it. The next stock here is a company that specializes in cybersecurity, and that's become a big buzzword, election notwithstanding. It's become kind of a big thing in terms of protecting your network. And whether that network is in your home or in your office, it is very important to protect the data that you have. This company offers hardware and software. It includes firewalls, virtual private networks, which have grown in popularity, as well as anti-malware software, so you don't get Trojan horse viruses, things like that. It's got a product line that's dedicated to secure switching for connecting customers and devices both in office and long distance. It's got trailing 12-month sales of about $2.5 billion, 1-year annual sales growth rate of around 20%, and its sales increased from $325 million in 2010 to $2.1 billion in 2019. So they've actually already topped their mark from 2019. This will be the 11th straight year this company has had sales increases. The company has 1-year earnings per share growth rate of around 19%. It's got a 3-year annual earnings per share growth rate of 117%. Stock-wise, they hit a low of around $75. Guess when? March. But since then, it has rallied about 98% into early July. It's pared back a little bit. It dropped about 18% off that July high, starting to make a little bit of a run. It's starting to move a little bit higher, so it's hoping to maybe erase that 18% loss and march back a little farther. The company here is Fortinet Incorporated, trades on the Nasdaq. The ticker is FTNT. Again, this is a company that does not have their name stamped on packages of product. You're not going to find, or it'd be very rare to find Fortinet products at Walmart or Target or Best Buy. They're just not there. These are higher end cybersecurity products that are used at data centers. They are used in large offices, but they have brought those things down to be included into home products as well, which bodes well considering how now we're in this ever-changing work environment. So Charles, first your thoughts on Fortinet.
It has a good theme behind it. It's cybersecurity is one of the biggest themes of our day. I mean, who hasn't had an account hacked, a credit card hacked? Yeah, this is a big deal. So cyber, and every company in the world has to have a cybersecurity policy. Any financial institution you do business with, you will always, every year, you will get that notice in the mail detailing their cybersecurity policy.
That's right.
No one ever reads it. You just, I mean, you get it, you toss it. I mean,
it's like the terms of agreement with iTunes or Google. You don't actually read it. You just click I accept, and then you hit, and then you accept it.
Every letter, and then of course, no one reads it. No one ever reads it. But yeah, there's a good story here. Cybersecurity is a big theme. What I find disturbing about this stock is that it has had absolutely no momentum since summer. At a time when, a lot of the tech stocks sort of had a near-term top in the summer. They corrected a little bit, and then it was off to the races again. This stock did not participate in that. And I don't know why. And because I don't know why, because I can't pinpoint why, that makes me a little uncomfortable. So I like the stock. I like the story behind it. The growth rates over the last several years have been fantastic. It checks all the right boxes. I don't understand why the price is not cooperating, given that every other tech stock has been on fire
exactly
over the same window. Something doesn't smell right there. So I would wait a bit on this one. I would wait to see if, what their next earnings report looks like. Maybe wait for that stock to resume something resembling a real uptrend, because all the right check boxes are there, but something's off. I don't like that it's been trending lower for the last several months.
Something foul in the state of Verona.
Denmark.
Wrong Shakespeare reference.
Wrong Shakespeare.
I had it, and then I just grasped at the thread. Yeah, I mean, fundamentally, you're right. Fortinet hits all the marks. Return-ons are all better than the rest of the industry, than the communications equipment industry. Value-wise, it's a bit high. It is a bit of a high-price stock, which could be a reason why it's traded somewhat sideways, because maybe the overvaluing has caught up with Fortinet before it has with anyone else. I don't know why. Financially, the company is in a very good position. $48 million of debt, trailing 12-month income of $2.4 billion. Their income, $470 million for the last 12 months. So financially, they're in a good place. Sales-wise, it's going to be the 11th straight year of sales increases. Fundamentally, they're in line. They are a bit overpriced, but momentum just isn't there. Adam's Green Zone ranking system puts Fortinet at a 59, which is a neutral position for us. Again, very similar to Avaya. We don't necessarily see this outperforming or underperforming the market over the next 12 months. It scores a 40 in momentum. That's low. A lot lower than I think any of us would be comfortable with, although it is a relatively low volatile stock. It scores a 67 in volatility. What stands out here with Fortinet is its quality and its growth. It scores a 99 in both quality and growth. So it is a quality stock. It is a high growth stock, and those stocks do tend to outperform the market. So to me, I am concerned about the momentum. I am concerned about the drop. I am concerned about the fact that this did not take part in the tech stock boom that we've seen since the summer. I'm just not sure why. So the question I have then is, okay, where does that put me in terms of my thoughts on Fortinet? Do I go strictly with the system, or do I kind of go out on a limb? And in this instance, I'm not going to go out on a limb. I'm going to stick with the system here. I'm neutral here. I'm like Charles. I like where this stock is. I like its story. I like its financials. I like its fundamentals. I think it is a very, very good tech stock, but there is some reason why Fortinet is not bouncing up the way other tech stocks are, and that is a concern. We buy high, we sell higher. The momentum is not there right now. So that doesn't mean it's not going to be. I think it will be. I think by January, February, I think a company like Fortinet will see that higher momentum. And then at that point in time, it will be worth a buy for you. But right now, it's just not. We're not seeing a significant uptrend that would warrant us to go out and say, okay, it may only score a 59, but its momentum is just out of the park, so you should buy it. I'm just not there. And I was really wavering on this because before Charles and I came on officially, I had told him, I said, I kind of like Fortinet. I think I might go with it. But the more I sat here and looked at it while Charles was talking, and the more I kind of talked myself out of it. So it's a pass, but it's probably a temporary pass, because I think Fortinet is one of those companies that's going to show a strong uptrend here in the next 3 months. So
it's funny with the first talk, we're saying, buy today, but keep your time horizon short. The second, it's maybe don't buy today, but potentially have a much longer time horizon when you do buy.
It can be one of those situations where you buy Avaya, hold it for 3 months, take advantage of some gains, pull those gains, and then turn around and buy Fortinet, and then capitalize on those gains for 3 to 6 months afterwards. It could be an interesting strategy if it were to play out. So that we didn't plan it that way. That was not we weren't scripted. So we didn't come into it. How about we do this? That wasn't the case at all. So so on Avaya, it's a very short-term buy for us. On Fortinet, it's a very short-term hold for us. So don't buy it, but keep your eye on it, because Fortinet could be one of those that maybe the tech stock uptrend is maybe late in coming to Fortinet. Who knows? It's hard to predict. So that's going to wrap it up for us. I do want to remind you that Adam Odell's Millionaire Masterclass is out and ready for you to take a look at, and you definitely want to. This is a strategy that Adam used. He retired at the age of 33. I'm not 33. I wish I would have known it. I could have retired, or at least come close to it, or bettered my portfolio. But it is a tried and true method. It is based on the momentum principle, but you're going to want to learn about it. If you head over to the website, theinvestingsecret.com, that's where you can get more information on how Adam used this process and how he uses it today. He uses it now with his Green Zone Fortune service, as well as his Cycle Line Alert service, both of which are doing very well. So you want to make sure you do that. It's theinvestingsecret.com. So make sure you check that out. Also, if you're listening to The Bull and the Bear on podcast, you can check us out on video. Just head over to our YouTube channel, and type in Money and Markets in the search bar. Make sure you subscribe and then hit that notification bell so you get notified each and every time we put out a video. The community is growing. It is great. People are really active. They talk a lot, whether it's trashing me for telling you not to buy Pfizer, which I still believe, don't buy Pfizer. BioNTech, probably much better, but that's beside the point. Or whether you're there for cannabis or trying to see what's going on in our week ahead. Or maybe you just like to see Charles and I's bright, shining faces every week on the Bull and the Bear podcast. It is on video. If you're maybe watching video and you want to listen to us on podcast, we're on Apple Podcasts, Google, Spotify, iHeartRadio, Amazon, and a wealth of others, including about 5 in India, which I didn't even know existed. But we are actually on in India, and we appreciate those folks in India that are downloading our podcast, listening to us, as well as everyone around the world. We get downloaded in about 55 countries each and every week. So we appreciate the worldwide listen. So make sure you do that. Leave us a review. Leave us a comment. If you do have a comment or question or a stock or a sector you'd like us to look at, the email address is thebullandthebear@moneyandmarkets.com. So that's about going to do it. We hope that you all have a great weekend. We'll have much more with our week ahead video that'll come out over the weekend as well. So make sure you kind of get yourself ready for what next week has in store on Wall Street. That will be coming out as well. And the next week, our marijuana market update and the Bull and the Bear podcast. So a lot of stuff coming out. We're also kicking around some new ideas too on some things, on some new videos for you. So make sure you stay tuned and watch for that. So for Charles Sizemore, I am a research analyst for Money Markets, Matt Clark, your host of the Bull and the Bear podcast. Until next time, everyone, safe trading.